What if I told you a 167-year-old financial giant didn't collapse because of a global crisis, but because of its own slow decay? March 2023. Technically, it was called a rescue acquisition. In reality, it was a quiet execution. Over one single weekend, one of the pillars of global finance disappeared. Not with an explosion. Not with chaos in the streets. Just a signature on a deal. And that might be the scariest part. For decades, Credit Suisse looked untouchable. It survived revolutions, 2 world wars, the Great Depression, the 2008 financial crisis. While others begged for bailouts in 2008, it appeared steady, almost disciplined. That survival built a powerful narrative. This bank knew how to manage risk, but survival can create arrogance. To understand how it unraveled, you have to go back to 1856. Alfred Escher wasn't just founding a bank, he was helping industrialize Switzerland. Railroads. Infrastructure. Capital for a growing nation. Credit Suisse didn't just store wealth, it financed the literal tracks that connected the country. Over time, it became synonymous with Swiss banking. Private, discreet, stable. If you were ultra-wealthy, this was where your money slept peacefully. Then the world changed. After 2008, interest rates collapsed. Regulations tightened. Making money the old-fashioned way became harder. For big banks, low interest rates were a double-edged sword. Cheap money was everywhere, but margins were thin. So if you wanted high returns, you had to stretch, take more risk, push a little further. That's when cracks began forming. First came Greensill Capital. Supply chain finance products were sold to clients as safe, low-risk investments. Then, in 2021, Greensill imploded. Billions were frozen. Clients were furious. Lawsuits followed. It wasn't fatal, but it damaged credibility. Before the dust even settled, Archegos capital exploded. Bill Wang's family office was using extreme leverage to bet heavily on a handful of stocks. Credit Suisse was one of the prime brokers facilitating those trades. When the positions collapsed in March 2021, the bank lost over $5 billion. Not because markets are unpredictable, not because no one could have known. Internal investigations later showed risk warnings were ignored. Limits were bypassed. Oversight was weak. This wasn't bad luck. It was complacency. From there, the headlines kept stacking up. Money laundering issues, corporate spying scandals, constant leadership turnover. Each event alone was survivable. Together, they formed a pattern. And in banking, patterns matter more than isolated mistakes. Because banking isn't really about money. It's about confidence. By 2022, the macro environment turned hostile. Inflation surged. Central banks began aggressively raising interest rates. The era of cheap money ended, and when cheap money disappears, hidden weaknesses become visible. Credit Suisse reported heavy losses. Its stock price slid. But the real danger wasn't in the share chart. It was in client behavior. Wealthy clients, the lifeblood of the bank, started withdrawing funds. Not dramatically at first, but steadily. Then came March 2023. Silicon Valley Bank collapsed in the United States, sending shockwaves across global markets. Investors and depositors began scanning the horizon for the next weak link. Social media amplified fear at lightning speed. When Credit Suisse's largest shareholder publicly stated they wouldn't inject more capital, the psychological shift was immediate. It stopped being a performance issue. It became a trust issue. And in the digital age, a bank run doesn't involve lines outside a branch. It happens on smartphones, billions left in days. Once that momentum starts, it's almost impossible to reverse. The Swiss government understood the risk. If Credit Suisse failed chaotically, contagion could spread. So in a tense weekend negotiation, UBS, its longtime rival, agreed to acquire it. The price was a fraction of what the bank had once been worth. Shareholders were crushed. A 167-year-old institution effectively vanished. No dramatic bankruptcy hearing, no global meltdown, just absorption. It's tempting to look for a single fatal mistake. A smoking gun trade, one rogue executive, but the truth is less dramatic and more uncomfortable. Credit Suisse didn't collapse because of one decision. It eroded over years, culturally, structurally, strategically. It survived external crises because those were visible enemies. What it couldn't survive was internal decay. And here is the uncomfortable question. How many other institutions are standing on similar cracks right now? History doesn't grant immunity. Longevity doesn't equal stability. Size doesn't guarantee safety. Credit Suisse proved that even institutions woven into the fabric of global finance can unravel surprisingly fast once confidence evaporates. At the end of the day, a bank is not its marble headquarters, not its history, not its brand. It's a collective belief, and once belief disappears, so does the institution.